I will distill 20 years of mutual fund expertise into just 15 minutes today. Yes, in just 15 minutes. And this is the knowledge from 15 different books written on mutual funds. You can think of it as everything from selecting the best mutual fund in life to SIP, SWP, STP, whether to invest in a small cap fund or put money in a mid cap fund, whether more money can actually be made in a large cap or in an index fund. We will clear everything up in just 15 minutes, so don't miss this video by mistake. This really might turn out to be one of the best videos of your life. And truly, believe me, I can give it to you in writing that this particular video is going to be one of the best videos you have ever seen in your life. It will effectively teach you how to generate wealth worth several crores by utilizing long-term investing in mutual funds. And if this is not true, feel free to dislike the video. And you can write whatever you want in the comment section. It's your choice. First of all, let us get one thing straight regarding everything you have previously heard or understood about mutual funds. Believe me, when I say that almost 60% of it is false, whether it is a YouTube video, a written news article, or even a book by a major mutual fund author, very many things within them are nothing but half-truths. And yes, I'm telling the truth. 60% of it is a lie, or you can say it's a half-truth. And let me tell you something. A half-truth is often considered to be much more dangerous than an outright lie. You will understand how as we go on. As a classic illustration, individuals truly believe that by choosing to invest in a flexi cap fund, their money will be equally diversified across large cap, mid cap, as well as small cap stocks. But this is a huge myth. The reality of flexi cap funds is quite different. For all the flexi cap funds in India, the reality is that most funds have 65 to 70% of their AUM invested only in large cap stocks. This means it's invested in stocks like Reliance, HDFC, and Infosys. And if you happen to invest 1000 rupees in any flexi cap fund, then 600 to 700 rupees out of that are invested in large cap stocks only, where alpha is not created, and hardly 300 to 400 rupees are invested in small cap or mid cap. Yes, however, there are some flexi cap funds that prove this particular theory wrong and truly give you real diversification. But think about it. If you only want to invest in large cap stocks, then why pay a fee of 2 to 2.5% to the AMC and fund manager every year? Just put your money directly into a Nifty 50 ETF. If you truly want to create real alpha, you should look to invest in mid cap funds. Because in the last 10 years, the average small cap fund CAGR is 16%. And for mid cap funds, it's about 18 to 19%. And this happens because the small cap category has more than 800 stocks, and sometimes over diversification occurs. And some stocks also have accidents. Meaning, if a small cap fund has invested in 120 or 140 stocks, then 2 or 3 companies out of them might unfortunately fail. Yet I am not saying they will go to zero, but sometimes their stock prices can indeed crash by more than 50 to 60%. And because of just that accident, the entire fund's average return gets completely ruined. Generally, people think that in small cap funds, we will get high returns with high risk. But this is not always true. Only a few selected small cap funds are able to outperform the market. Many funds can't even beat their category average. On the other hand, the chances of an accident in mid cap stocks are very low. You know why that is? Because they are already large and established companies with a very proven track record of their business model. Moreover, the mid-cap category has only 150 stocks. Out of them, mid-cap mutual funds create a portfolio of 60 to 70 stocks. And this is the system that is able to create alpha. A portfolio of high conviction stocks. If your portfolio has 100, 150, or 200 stocks, your returns will get diluted. But if your portfolio instead has high conviction, containing roughly 30 to 40 stocks that are fundamentally very strong and can yield outstanding returns in the long term, then your portfolio will truly be able to outperform the benchmark index. See, whenever you choose to invest in mutual funds, you must remember these 3 rules. Rule number 1, don't invest in more than 3 mutual funds. Well, the reason that I am saying this because all the large cap funds present in India, I have personally analyzed all of them. In total, there are 34 large cap funds in India. Look, the analysis of all of them is on your screen. If you happen to select any 2 large cap funds, you will discover an average overlap ranging from 47 to 65% between them. This means more than half of the portfolio consists of the exact same stocks. So if you invest in 2 or 3 large cap funds, you will pay an expense ratio of 2 to 2.5% to each fund manager and AMC. And what will you actually get in return for that? Nothing but the same old large cap stocks that are identical in almost every mutual fund. Furthermore, the top 5 universal stocks that are practically identical within all 34 of these mutual fund schemes specifically consist of HDFC Bank, ICICI Bank, Reliance, Infosys, and TCS, all present in every large cap mutual fund. This means real diversification is not happening. If you are investing in more than one large cap fund, you are just basically paying an unnecessary expense ratio. So never invest in more than one fund of the same category. I have personally seen many people proudly say, hey, look, I have 12 mutual funds. Some people say they have 15 mutual funds. It certainly sounds diversified, but in reality, it is complicated. When you examine the portfolio, you see that while large cap, flexi cap, and multi-cap funds seem distinct, their actual holdings are identical, as most funds simply hold the same top stocks like HDFC Bank, Reliance, ICICI, and Infosys. Now think, if the same stocks are in every fund, you are not diversifying, you are actually duplicating. And what's the result of that? Portfolio tracking becomes quite difficult, overall returns get diluted, and rebalancing starts to feel almost completely impossible. Because if you take money out of one fund and put it into another, you'll find that it has the same stocks too. Always remember that. 4 to 5 well-selected mutual funds can outperform a portfolio of 15 random mutual funds. Now, let's come to your favorite question. Which mutual fund should I invest in? It's simple. Look, large cap funds can give an average annual return of 10 to 12%. Mid-cap funds averaged 18 to 19% returns over the last decade. This means the category can beat large caps in the long term. Currently, there are 33 mid-cap funds available in the Indian market, out of which most of the mid-cap funds are invested in more than 50 stocks. For example, look at the investment style of HDFC Mid-Cap Fund. It has a diversified value and growth blend. Its portfolio has more than 75 stocks. Edelweiss Mid-Cap Fund has 90 stocks. ICICI Mid-Cap Fund covers 85 stocks. This means, again, the chances of returns getting diluted are high. If you wish to create alpha by taking a little bit of extra risk, then select a fund that only holds a portfolio of 30 to 35 high conviction stocks in total. For example, HDFC Mid-Cap Opportunities Fund and Motilal Oswal Mid-Cap Fund are both top-rated funds. But their investment styles are quite different. HDFC is a large and well-diversified fund that gives steady returns, whereas Motilal Oswal is a much more concentrated and high-growth-oriented fund that can generate higher returns, meaning it can create alpha. But its volatility, meaning the ups and downs, can be a bit high. If you want to invest for the long term by taking a little more risk and want to generate high returns, then this fund could be right for you. Talking about portfolio strategy and holdings, HDFC Mid-Cap Opportunities Fund has a very large AUM. Therefore, it diversifies its money across many stocks. This particular fund actually follows the growth at a reasonable price policy and holds heavy investments in sectors like financials, healthcare, and automobiles. On the other hand, Motilal Oswal Mid-Cap Fund comparatively takes high conviction bets on fewer stocks. The fund manager makes aggressive calls in mid-cap and small-cap stocks. Because of this, it rallies very quickly in a market upturn and often outperforms the market. HDFC Mid-Cap Opportunities Fund is best for those who want a steady, safe, and reliable mid-cap fund that can withstand every market cycle. But Motilal Oswal Mid-Cap Fund is best for those who are looking to generate alpha in their portfolio and target substantially higher returns over the long term. But before investing in any fund, understand one thing carefully. Just like in cricket, we don't judge the best player based on the score of just one previous match. Instead, we judge them by their performance in the last 15 to 20 matches. Similarly, you should never select an equity fund based on past one-year returns. This is the biggest mistake. For example, the Motilal Oswal Mid-Cap Fund clearly underperformed its own category average in the last 1 year. So, in this fund, lump sum investors got a return of -6% and the SIP investors got a return of -9%. Whereas the category average return was around +8% for both SIP and lump sum investors. This means if I look at only 1 year's data, I will find this fund to be very bad. But what retail investors do is, they assume that as soon as the portfolio shows a loss, they start to panic and decide to exit the mutual fund prematurely. But the true reason for the fund's underperformance is actually something else, which retail investors miss. But many people usually make a common mistake while choosing a mutual fund. They go on Google or some app and immediately look into the return that was given in the last 1 year. When a fund shows a 30% return, they will immediately say it's the best. But if it gives just 10 to 12%, they'll call it boring and decide not to invest. And they make their whole investment decision based on just this. But the real problem starts right there. You know why? Because the 1 year return only shows you a trailer. But 1 year returns don't actually show the full picture of the fund. Imagine if a student scores 95 marks in one exam. Can we instantly call them a topper? Of course not. Because you really will see how their overall performance was. Whether they have shown the same performance consistently in every single exam. Whether they have the ability to handle pressure or not. Just in that way, the exact same logic also applies to mutual funds. The real test of a mutual fund is consistency. Because you are really not investing in a mutual fund for 2 or 6 months, you invest in mutual funds for the very long term. So when it comes to investing in mutual funds, you need a fund that can consistently outperform in the long term. And to check consistency, do you know what smart investors look at? Rolling returns. Now let's understand rolling returns in simple language. What are normal returns? How much return did this fund give from January 2023 to January 2024? If it earned 25%, I would think, wow, that is very good. But the question is, were these returns achieved only in that same period, or were they achieved every year? If you invested 6 months earlier, would you have gotten the same returns? If you invested 1 year later, would you have gotten the same returns? If it wasn't a bull market, if the market was a bit sideways, would you have gotten the same returns? Well, this is the biggest loophole of point-to-point returns. Because in point-to-point returns, you calculate returns from only one specific date. Whereas with rolling returns, that same fixed period is calculated again and again from various different starting dates. Suppose we are looking at a 5-year rolling return, then you will see the returns from January 2015 to January 2020. Then returns from February 2015 to February 2020. You will also see the returns from March 2015 to March 2020 and average them all. This is what we call rolling returns. This will continue to run and be calculated continuously. Well, you don't need to do it. This option is already available on most websites and apps. Now you will know whether this fund has performed well only in one lucky phase, or if it can genuinely show consistency in every market condition. And this is the real truth, because the market is not always the same. Markets fluctuate, crash, or turn sideways, and sometimes panic ensues. A real quality test of a mutual fund is achieved solely when it performs reliably in different market cycles. And that is precisely the reason why we should always prioritize analyzing the consistency of rolling returns. That's why I personally follow a very strong rule. If you have to judge a mutual fund, simply do not look at the last 1 year's return at all. Don't look at it. Always check the rolling returns for a minimum period of 5 years. This is a very powerful and essential habit. If you make just this one simple change in your mutual fund selection habit, there's a 90% chance that you will be able to make better returns than others. Because a 1-year return often creates excitement, but a 5-year rolling return creates conviction. And big investors invest crores of rupees based on conviction. Many times you will simply see that a fund that was a top performer in the last 1 year actually has some very weak rolling returns. This means the performance is very inconsistent. And sometimes the opposite can also happen. The 1-year return will look average, but the 5-year rolling returns will be very strong. This means the fund is silently and consistently creating wealth. And honestly, this is exactly what a long-term investor wants. For example, let's check the return of Motilal Oswal Midcap Fund. Look, for SIP investors, the return in the last 1 year is negative 10%. But the 1-year rolling return is positive 14.55%. And the 5-year rolling return is 21.42%, which is much higher than the category average. This means it is outperforming the market. So next time you finally decide to select a mutual fund, don't just look at the star rating or the recent returns. At least check the rolling returns of the last 5 years. And yes, once you have started an SIP or invested a lump sum, don't open the app every other day to check your portfolio. Most retail investors make this mistake. They check on Monday, then on Tuesday, on Friday, and then if they are free on Sunday, they'll open their portfolio again. Well, if the NAV has gone up, you'll be excited, and if it has gone down, you'll be anxious. And this is when you make wrong decisions. Fix one thing in your mind: equity mutual funds are not meant to be a daily scoreboard. Constant over monitoring is dangerous. You know why? Because when you look at your portfolio every day, your emotions get activated. And activated emotions often result in panic selling. Or you will switch funds, or you'll keep chasing performance. Many times you will feel that your fund is not performing well, and you will exit. And only after that, the fund's real performance will start. Remember, as a long-term investor, you should avoid checking your mutual fund portfolio every single day. Ideally, you should review your portfolio once every 6 months or a year, or based on your goal-based tenure. Unless there has been a major change in the fund manager, or the fund's investment style has changed, or there is a case of severe underperformance. Look, a mutual fund is not a magic box, and it's definitely not a guaranteed return machine. Here, the market's volatility is tested. And if you are a disciplined investor with a long-term mindset and understand the right category, you can create wealth worth crores in the long term. A mutual fund is undoubtedly a powerful tool for compounding, but it is also very important to use it correctly. If you invest in a wrong scheme, and if that scheme underperforms the market for 15 to 20 years, real wealth will never be created. Your 20 years will be wasted on top of that. Today, there are more than 2,000 mutual fund schemes available in the market. And honestly, this is the biggest confusion. Because people get confused even before investing in mutual funds. Which fund will be the best? Which fund will give us good returns? Which are the top returning funds? Should I invest in a direct fund or a regular one? Let me do one thing. I'll check names on social media and I'll invest in whichever one an influencer suggests. But to be honest, selecting a mutual fund is not like selecting a mobile phone or a shirt. Choosing a fund just by looking at the highest return is the biggest mistake, because a fund that was a top performer in the last 1 or 2 years won't necessarily be the champion in the future. Most of the time, funds that have underperformed in the last 1 or 2 years change their strategy and outperform the market. So the mutual fund game is not just about which fund is the best. What is the real game? How many funds should you have in your portfolio? There should be a maximum of 3 to 4 funds, and that too from different categories, as per your risk appetite and investment tenure. Second, how should consistency be judged? Based on at least 5-year rolling returns. Number 3, don't spoil your portfolio by overreacting. You definitely should not exit and switch investment funds repeatedly. And number 4, you should not miss the market's best moments. So, whether the market crashes or recovers, keep investing. Wealth is built not just from returns, but from right investing behavior. If you enjoyed this video, please like and subscribe to our channel for more insights. Jai Hind.